for joining today. Today we have the former Chief Risk Officer of Bank of Montreal, Kevin McHugh, from Ireland, and currently he's with QBS Management Consulting firm. Kevin, thank you so much for joining today. Could you please tell us a little bit about yourself?
Okay, so I'm an accountant by background. I worked with the Big Four from the mid-'80s until the mid-'90s in Ireland, in Europe, and in the United States. After spending that period, 13 years with the Big Four, I joined the stock exchange as the head of regulation and trading. Spent 4 years there, and then moved into Allied Irish Banks, which is one of the major banking groups in Ireland. I held a variety of compliance and risk roles there. As you'd expect, over a 15-year period, the bank went through restructurings from time to time. So my roles changed as that happened. So I started off in the capital markets division, moved into the business bank, and then moved into the restructuring unit. And then in 1994, sorry, excuse me, 2014, I moved into Bank of Montreal. So that brings us up to the start of this year, when I set up a boutique consulting firm, which is QBS Management.
So Kev, in your view, what makes banks? What could make banks different in these times, where we are really, facing the fintech disruption and a lot of technology disruption and the fourth industrial revolution? How would banks have a competitive advantage over other banks in these times?
Yeah, I think that a lot of what needs to happen for banking to fare well is that they need to build trust among customers, build trust with regulators, build trust with staff. If you go back to the 80s and 90s, when I started my career, banking was one of the areas where the teenagers and the guys in their early 20s said, banking is a place I want to go. That's not their first choice at the moment. There are many choices that go to before that. There have been many cases where we've let our customers down. We need to right that ship. In many ways, we're in the same position as any other industry. You can damage trust very easily. It takes a long time to rebuild, and we're in a position where we need to do that rebuilding.
So in your view, what are the top risks that the bank boards are concerned about? Across all the categories, like within market, credit, liquidity, operations, what, according to you, are the top risks that bank boards are really concerned about and trying to prioritize?
Okay, so if I look at a couple of categories, I mean, the first one I'd mention is what I'd call political risk. So if you look at the level of uncertainty in the environment we're operating in at the moment, in Europe you have Brexit. Brexit is due to occur in March of next year. At the moment, there are very few people can safely say what's going to happen at that point, and what shape the relationships between the United Kingdom and the rest of the world will be at that point. If you look at the risk of trade wars, which has significantly increased over the last 6 months, if you look at the changes in the interest rate environment, we've had many years of virtually nil interest rates. And now in a number of geographies that's moving ahead very quickly. That puts us in a position where many bankers who started their career after me will have no experience of dealing with that sort of environment. So that's significant. Cyber risk would be another risk that needs to be considered carefully, and then of course conduct risk. And conduct risk is one of the categories that most directly has affected our customers. And that's an area where we need to up our game and do a lot better.
So is conduct risk one of the top agendas of the bank boards? And if yes, then what are the measures or steps that the boards are taking to make sure that the conduct risk is managed effectively?
Okay, so I think that the answer to your first question is yes. I think that conduct risk is right up there. But I think it's a broad definition of conduct risk. It's about anything which you do which relates to the dealings with your customer. I know there's a number of definitions of conduct risk which are out there, but taking a broad definition of what conduct risk means, I think that yes, it's absolutely up there. And what happens in order to improve the level of conduct risk? I mean, there's a number of things. I think it starts with culture. If you can view the failures of country risks as being individual items, or you can view it as being a pattern. Um, the key to getting any of these things right starts with culture, and it goes from there. It'll include things like, for example, adequate resourcing. It'll include things like organizing the way in which you manufacture and distribute your products, starting from a customer perspective. So all of those things, I think, will be important mitigants as we journey towards where we want to be.
So I wanna focus on the point that you said building culture is important. So building a lean risk culture is really crucial in strengthening the risk management practices across the organization. And how do you think the chief risk officers, or even the middle management or line management, could take steps in order to foster this lean building of this lean risk culture?
Yeah, I think it changes between the two, between the risk management function and between the rest of the firm, and a lot of it is going to come down to where the risk management function positions itself. The risk management function can position itself as being the expert on a variety of types of risk, market risk and credit risk and conduct risk and all the other types of risks that we could mention, or it can position itself more strategically. If it positions it more strategically, it can't be either or, because you have to do all the things that go with the day job. But the successful risk functions will go beyond that and will be part of the it will be a significant driver of the overall strategy for the firm. On the other side of your question, which is what about the rest of the firm? The three lines of defence and getting that right and getting ownership right, I think is absolutely very important. And the funny thing about that is the three lines of defence have been around for a very, very long time. So you might think that this is going to be straightforward to get this right, but funny enough, it's as often wrong as right. So getting that right is probably one of the and driving accountability through that is probably one of the most significant features, which will determine whether the front line and the other support areas take ownership and get this right.
It's funny you mentioned that. I just recently was talking to another chief compliance officer at another bank, and I think his main concern was also three lines of defense. And this is a common thematic problem that all banks are currently seeing: the failure of the three lines of defense. So, what do you think contributes towards the three lines of defense not functioning effectively or being able to fulfill the objective that they are supposed to?
I think there's a number of things. I mean, I think that if you start at the start, if you're running a business line, you've pretty demanding targets, and they're typically revenue based, return on asset based, the potentially something around new business, that sort of stuff. But they're all around that sort of stuff. Now, in the well-run banks, there will be a part of this about making sure that you do that within policy and within risk appetite. And where that works successfully, that will be an important contributor towards getting the three lines of defence right. But different firms are at different stages of evolution and getting to that point. There are firms, and there are firms which will have more than their fair share of problems, where they haven't gone as far as they should on that journey of saying that, listen, this is about balance. This is not about saying that you're either a revenue getter or you're a risk manager. You in a well-run firm, you need to be both. I suppose the other thing that I just mentioned, which is a significant feature which needs to be addressed, and it also impacts on the cyber risk, is legacy systems.
Right.
So across firms, you'll see a wide variety of system infrastructures. But most have legacy systems which are far more complex, where it's difficult to get the people to manage them, and where those are the systems that are being used by frontline guys. So, I have some sympathy when somebody comes along and says, look, you're asking me to take ownership of all of this, but I need the systems to do that. And where there is a significant element of legacy systems, that is one of the features which makes it a bit more difficult to get across the line.
That's true. So shifting the gears a little bit, if we talk about the data breaches and sophisticated financial crimes that are happening in this time,
Yeah.
what do you think would be the best way to manage or handle this, and how should banks be prepared in terms of their response strategy to really address this type of issues?
Yeah, the funny thing about the major data breaches which have occurred is most of them have not been particularly sophisticated. I mean, the focus and the publicity tends to be around the cases where, for example, you have international actors which are attacking either banks or defence institutions or whatever it might be. That's a very small portion of the difficulties that arise on the data side. Most of it comes down to just basic good practices on an ongoing basis, and driving that day in, day out, and being absolutely clear about what is the data that you just cannot get wrong, and taking it from there.
Okay. And so if you were to name one risk area other than cyber risk, which would benefit greatly because of the advances in the technology, say machine learning or AI or robotic process automation, what would that specific area be?
Okay, so other than cyber risk, um, it would probably be market risk.
Mm-hmm.
And a lot of that just comes down to that if you have basic technology in market risk, you're going to have to reflect that in a fairly conservative view on the risk measures which you use on a day-to-day basis. The more sophisticated you can get in your analysis of what's happening in the market and how you reflect that on your risk measures, the more that you can give leeway to take a more aggressive stance within risk appetite and within policies. So I think that's an area where there's a payback for investment in technology.
Okay, and then I just wanted to wrap this up by asking, what is your favorite life lesson quote that you live by?
Um, I think what it probably adds up to is that if you're somebody who has gone through life without facing any particular challenges, well, you probably won't have learned too much along the way either. I
Mm-hmm.
had a boss a few years ago, and when he appointed me into the role I was at that point, he said, "Listen, Kevin, part of the reason that I've appointed you is that you've been through a few things," and he used the phrase, "You've got a few war wounds." In general, if you haven't got any war wounds, you're probably not too much good to anybody.
Right. Oh, that's fantastic. Kevin, thank you so much for your time today. It's been a pleasure talking to you.
Excellent.
Take care.